Welcome to Kobe Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 141st episode. Today, we are recording this in Mumbai, India's financial capital, and appropriately enough, we will focus today on Indian financial markets. Ashish Gupta is CIO of Axis Mutual Fund, one of the largest and fastest growing asset management companies in India. Before joining Axis in 2023, Ashish was the head of India equity research at Credit Suisse. A veteran of financial sector research, he was well ahead of the curve back in 2011 to flag Indian banks' asset quality issues. Those of us in the know, we read those House of Debt papers. Ashish Gupta, welcome to Kobe Time.
Thank you for having me, and thanks to DBS for this platform.
It's great to have you here. You have a bunch of fans in Singapore. They're all looking forward to this conversation. Ashish, let's start with the here and now.
Sure.
The tremendously buoyant financial market conditions that we're seeing in India. Give us a sense of where you see things.
Sure. I think India, like most places globally, has been beneficiaries of really the turnaround in the economy and financialization post-COVID, right? And we've actually had an unprecedented run. Literally now, I think we are in the 9th year where we have seen every year positive return in the market. What has also happened over this period is that the Indian markets are getting more and more driven by domestic demand.
Absolutely.
And if you look at the stats over the last 4 or 5 years, it's quite amazing, right? So if you look in the number of equity market investors, right? And if memory serves me right, in 2020, there were 50 million. Today, there are more than 100 million, right? If you look at our business, which is the mutual funds, domestic mutual funds, 2020, there were a little over 20 million. Today, there are nearly 50 million investors. So really, I think we have seen a big retailization happening in the market. Equity market flows have been buoyant, but they have been very, very well distributed, right? So the typical ticket size of our investment coming into the mutual fund today is about 28,000 rupees, which is less than $400, right? So I think the fact that India has had large numbers had never really meant anything to the markets, and particularly equity markets, right? And people used to treat equity markets very tactically. That, okay, this year is looking good, election is going to happen, or is the market going to go up for the next 6 months, 9 months?
So a punt.
Right. Yeah. But now it's actually started becoming an investment allocation decision, right? So people are saying that, okay, X percentage of my savings every month or X percentage of my income every month is going to be allocated to equity
systemic
markets,
investment plan,
right? And you would have seen the numbers, right? So literally every month, there's almost $4 billion of $3 billion of these SIP money coming in. Aggregate inflow into mutual fund is about net inflow is about $4 billion a month, right? And we have seen this number steadily increase only. And again, since pandemic, this number has more than doubled. So I think that's really created this buoyancy, feel-good factor. The good thing is that the market till now or till recently has been supported by a corporate performance and earnings in the economy. So if I see last 3 years, market CAGR has been about 23-24%. The earnings CAGR has also been in the similar magnitude, right? Of course, it's not to say that there are not pockets of froth in the market, but very broad brush, broad benchmarks have till recently actually performed in line with how economy has grown and earnings for corporate India have grown. So I think that's good. But we are seeing actually literally every asset class. So real estate in India is booming, and the other big pocket of savings in India for household is gold. So all these three asset classes have done very, very well simultaneously.
No, very impressive. I'll give you an anecdotal evidence. Last night when I arrived at Mumbai airport, the immigration officer asked me about investment strategy. He wanted to know which stocks to buy and which mutual funds to buy. I told him in general, and then they asked me, no, specifically which fund to buy. So that sort of tells you about the exuberance in among...
So I don't know whether we should be happy or scared about these anecdotes.
Right. So in terms of, whether to be happy or cautious, give me a sense of this shift toward not spot equities, but futures and options. And I've seen some stories about it. So give me a sense of what's happening there.
Sure. So I think what has happened in India, like other places globally, is that the futures and option market has also taken off, particularly since pandemic. I think proliferation of social media has also contributed, and the third is really digitization and really very easy to use apps, right? And what that has meant is that there are these products, and one particular product in particular, which is the index options. And as more differentiated products were introduced, we got weekly expiries of indices, and within that, on the expiry day, right, because the time value of the option is very, very low, the premium to the notional value comes down to really a minuscule amount. And in fact, the imputed leverage, if you are trading this index option on the expiry day in the afternoon, and option value will go to zero because time value goes to zero. The leverage on offer is as much as 400, 500 times the premium, right?
Okay.
So that is attracting a lot of retail punting and what I call lottery-like investing. And the paper I wrote on this was called gamification of equity markets, right? And we saw nearly 4x increase in these option traders, and literally all this trading just happens on the expiry day, right? And SEBI also published papers on this, highlighting that in many of these indices, as much as 96% of trading happens on the expiry day. About 30-40% of the trading happens just in the last hour. And really that just shows, because that is the time when the leverage is highest, right? And like a punt, right? You get instant gratification. You make a punt, within half an hour, you know whether you've made money or not. And the numbers there have just been staggering, right? If you look in terms of notional value, the amount of these options notional was nearly 500 times the cash market volume, right?
Wow.
So over the last 4-5 years, even though the cash market has grown, this has grown at a multiple of that. And that just tells you that not all the activity, or actually most of the activity, is not being done for hedging purposes, but there is just some other motivation. Again, the regulator has been quite on the point. So about 2 years ago, they published a paper showing that 90% of the people doing these options actually lose money, right? And the magnitude of losses in aggregate are not minuscule, right? So if I recollect correctly, households are losing about $7-8 billion annually doing this, right? So there are staggering losses that are happening. But the interesting part is that despite the losses, 70% of people are still doing these options. So that just tells you that this is not an investment behavior, but it is, for the want of a better word, a gambling instinct. And The regulator has since taken cognizance of this. The central bank has taken cognizance of this. They are trying to monitor whether unsecured consumer loans are going into these activities. They have, you would recall last October, this risk weight there, the capital market regulator has come out and increased uh, some of the notional value of the options. They are limiting the number of weekly expiries that are there. So regulators are trying to curb this instinct so that there is no macro or even micro risk that build out.
Right. Ashish, one could argue that people have the right to lose money.
Sure.
If they want to take a bet, there should be two-way outcomes. It should not be just one way, and the regulator should not just try to
Sure.
protect the downside.
Sure.
Unless they're being subject to misinformation, mis-selling. So was there an element of very aggressive marketing that led to this phenomenon taking off?
Okay, so there are kind of 2-3 contexts to this, right? So one is what's a regulator's role, right? Is it a nanny state or not, right? So clearly you don't want to be a nanny state. People are free to make decisions, right? But you also want orderly development of the capital market,
Correct.
right? So one part of it, does this lead to build-up of any macro risk for the market? And there they were already probably ahead of the curve. They had tightened the margin requirements, etc. But having said that, just the fact that this market was so much bigger than the cash market could mean that there are tail risks that can get created, right? So we have seen globally many instances whether the CDS market, etc., that if you let the derivatives market grow bigger, it can result in situation where the tail wags the dog, right? Because derivative actually needs to derive its price from the underlying rather than that market driving what is happening here. But I think there is another angle, even if we ignore the macro risk, right? If you look at the micro risk, right, it's very difficult to say that whether there's mis-selling, whether there is misinformation, and also whether in a society like India, what is the level at which there should be intervention by the regulator, right? So every investor is not an informed investor. So if you look and I think Singapore also has this concept of accredited
Absolutely.
investor, right? So you try to say that is the investor informed enough to be taking these risks,
Correct.
right? And as of now in India for option trading, that is not there, right? It is very difficult to so when the regulator thought about how to control this, you can say, okay, should I put a net worth criteria? Should I put a knowledge criteria? But if you do that, it's very difficult to implement and monitor, right? And if you see the demographic profile of the people who are doing this option trading, it is actually very different from even a mutual fund investor in India, right? So for mutual fund investors in India, about 60% come from the top 20 cities. The average age is about close to 40. Of course, it is getting younger, but a large corpus comes from this. If you look at the F&O traders, majority of them are under 25. Most of them are coming from some of the more economically backward states, etc., right? And so there's a huge disconnect, right? That people who are investing in stocks directly, mutual funds are coming from a different demographic, and people who are doing this option trading is coming from a different demographic. So I think there is a big disconnect. I think we are a young country, and I think for multi-year capital market development, we need young investors to have a good experience of the market, right? And I think it will be very unfortunate that if the younger generation, their capital market experience in the initial years gets colored by what they experience on this option trading, I think they might kind of shy away from it completely.
This is absolutely fascinating. I see a parallel between the gamification narrative we saw in the US with the meme stocks and so on. Again, very much a very young demographic phenomenon there.
Yes. And the unfortunate part is that, expiry day options became popular there as well. But India has become the largest market. And in fact, I have debated this or thought about this with multiple people, and why it has taken off so much in India compared to other markets, because expiry day options is not just unique to India.
That's right.
Right? But I think perhaps the reason is that in India, this is the only legal form of gambling.
I see. Yeah, well put. I think China has struggled with this issue as well. And as you've seen, there's a lot of regulatory move in the last 4 or 5 years to, again, take away some of these tools from people to speculate. Ashish, I want to stay with the listed equity space a little longer.
Sure.
We've talked about the sort of buoyant flow environment we've seen, and away from the F&O, at least on the spot equities, good flows, good sentiment, and it is investment, it's not speculation. That's all great. Pipeline. What's been the experience with IPOs the last couple of years, and what does it look going forward?
Yeah. So actually, I'll kind of broaden the question a little bit. So we have seen over the past 4 or 5 years, as we talked about, domestic demand for equities being very strong, and that is coming both from inflow into mutual funds. In addition, there has been increased inflow into insurance companies and pension funds, because even the government-owned pension entity has started a few years ago to invest in the market. And third, with the buoyancy in the market, there has been direct participation of retail also in the market, right? And we believe today there is about $7 billion of consistent demand for equity that is coming into the market, which is through the SIPs, the pension plans, the insurance plans, etc. Right?
Every month.
Every month, right? So that is a very large number. And just to give a context, this number last year in aggregate was kind of about $55 billion. So it's kind of stepped up last couple of months to about $7 billion, right? So there is very strong, consistent demand that we see. And in addition to that, there will always be kind of, depending on the sentiment, more people will be directly investing into equities, or more people will kind of do lump sum investment into mutual funds. Interestingly, foreign investment over this period, so that is another large pool of demand, and foreign investors actually had been very overweight India. Till a few years ago, more than 20% of corporate India was owned by foreign investors. And that has been there for the last 25-30 years. But since 2021-22, they actually have been less so interested in India. And I think the principal reason for that has been what happened to global cost of capital, right? So as global rates went, foreign investors kind of pulled back. And if I remember correctly, in financial year 2022, foreign investors actually withdrew about $20 billion. 2023 was about $5 billion or so.
Didn't hurt Indian stocks.
Right. And last year, they again came back to India. But the interesting thing is foreign investors have invested probably in aggregate in the last 5 years or last 4 years only about $10-15 billion, where India's weight in the emerging market index has gone from about 8% to 18%, right? And in the global benchmark has gone from less than 2% to 3.5%. So foreign investors have actually been becoming more and more underweight India, but because there was this large pool of domestic demand, your market continued to run. As market multiples have gone up, we have seen, particularly in the last 18 months, very a sharp increase in what I call supply of equity. And you spoke about one aspect of it, which is IPOs. But interestingly, there has been larger increase in supply coming from QIP, that is primary raises that listed companies do. And the other piece is secondary stake sales. So promoters and private equity actually selling stakes. And interestingly, in the last 18 months, so if I take April 23 to till September, uh, uh, the supply of equity has actually outpaced this demand and actually been nearly 1.5 times the inflow into mutual fund. So while all of us talk about how, and we also started with that, how mutual fund flows have grown and become bigger, the fact is that there has been very large selling as well. And I think that is what is really determines the true market, right? A market is a self-correcting animal, right? So if demand goes up and price, which is valuation, goes up, you see supply coming. And with valuation going up, we have seen various forms of supply coming, right? So promoters feel that their multiples are high and they kind of take money off. Companies feel that it's a good time to raise equity, to invest, or now even just to build a war chest of cash on the books. We have had, interestingly, multinational companies selling down their stakes in Indian companies, so in their Indian subsidiaries, right? And very recently, we actually had one Korean auto company listing their Indian subsidiary and actually is paring down their stake and taking the money out. And the reason was simple, that their Indian subsidiary was getting valued at 4 times the multiple that they were enjoying back home. And now we are hearing there are a couple of other Korean majors who are looking to do the same, right? So that just shows that in today's world, money is fungible, right? So so if there are valuation disparities, people will look to kind of arbitrage it, right? And just to give you some numbers, last year we saw nearly 2 trillion rupees of secondary stake sales by promoters and private equity, right? And one question most of the economists actually ask is that while the foreign portfolio investment story in India is so good, there's China plus one, economy is doing well, FDI in India has not really grown. And one of the reasons is that this is the net FDI number because a lot of private equity, etc., have been selling into this strength of the market and taking money out.
Fascinating. So a juxtaposition of retail demand against institutional selling.
Yes. And this is actually going to increase. In fact, we were looking at these numbers just a couple of weeks ago, and the pipeline that is there for the next 6 months, just in terms of IPOs, is nearly 3x what was there in first of this financial year, right? So these numbers are actually becoming larger.
Right. And what has been the experience of the recent IPOs, first day move and subsequent track record?
Yeah, so I think over the last 18 months, IPOs, and given the retail interest, have actually done fairly well. There have been typically first day gains, but in most cases, post listing, the performance has not been that great as well. And I think what also happens is that all pre-IPO investors are locked in for the period of time, right? So the float that is there initially is not as large as the total equity base. And as over time, as those lock-ins expire, whether it is the private equity that is in the company that provides more supply, some of these valuation excesses actually moderate out.
Right. Why hasn't RBI's hiking of interest rates not dented margin trading and overall equity market sentiment?
So I think the good thing is that today, compared to the past, there is not as much leverage in the market, right? So RBI has been very prudent for last few years in terms of allowing NBFCs to do a lot of margin-based lending. In fact, banks are literally not allowed to do that. The margin requirement is very onerous. So typically, LTVs are nearly 4x. So basically, LTV is only 25%. So there is not as much leverage that is riding into the market, and that is why we have seen the stability in the market. So that and one sure sign of looking at leverage in the market is that if there's a big down day in the market, next day is a bigger down day in the market, right? Because all the margin calls come. If you see last 4-5 years, you have one down day and next day actually there is some value buying that emerges. So I find that margin-based buying in the market has been actually limited.
That's good to know. And this is taking into account the 400-500 leverage discussion we had on the F&O side.
Yeah, so that actually I feel is just a separate animal.
Uh-huh.
That's actually just operating in a separate bubble of its own, as you call it. And again, because it is primarily just index options, so even if you look at single stock option, you have not seen that kind of ballooning of volume, etc. Those are just those index products, weekly products, where you see that heightened activity, and you are not seeing, at least as yet, any impact of that on the underlying benchmarks.
Okay. So is the rising tide of the public listed equities also pushing up the private side of the market? Are we seeing M&As on the private side and private debt deals and all those sort of things?
So I think private debt is growing for other reasons, not necessarily because the public market has buoyed. And again, this is a trend that we have seen globally, how large private credit markets have grown. In India, private credit market is still relatively small. So despite all the growth we have had, I believe the total private credit market is today in India is only about $5 billion or so. One interesting thing that has happened in the last 3 years is that the composition of providers in the private credit market have changed. So till 3 years ago, it was a few large global funds that were very active here. As global cost of capital rose and Indian yields kind of did not go up commensurately, right? So globally, cost of capital rose by about 500 basis points. In India, it went up by 100 basis points. So they did not find it remunerative enough. They were kind of better yields available in other markets. So we have actually seen that shift happening. And so of this $5 billion, if 65% was foreign funds and only about 1/3 was domestic, today that has kind of shifted and about 60% is domestic funds, right? So if you look at private credit providers, Indian private credit providers, they have had large growth, but the overall pie has not grown as much.
Interesting.
But I'm actually quite optimistic about it because one of the reasons why private credit markets globally have done well has been more and more controls coming over the banks. That holds true even in India. Another driving factor has been that in India, banks are actually not allowed to do several activities globally. Banks, for example, M&A financing, we spoke about lending against shares, etc. So the rules are very restricted for the banks in India. So that is another opportunity for private credit because they can take multiple types of collateral that is not available for banks to take. Over the past 2-3 years, another dimension has been what's transpired for non-bank finance companies. So if you recall, in 2018-19 in India, there was a big liquidity crisis for the non-bank companies in India, and particularly those who were wholesale funded. So today, for the non-bank company that is giving out wholesale loans, the cost of capital is very high and primarily cost of equity, right? So the market actually does not pay multiple for the NBFC, which is into wholesale credit compared to retail credit. So most of the non-bank providers have shifted to retail products and not so much wholesale. So that market is also kind of coming more to the private credit space. So the opportunity is very large, but the aggregate pie for private credit is still relatively small.
If a sort of young entrepreneur is trying to take his or her fintech into a larger scale, where do they get the funding?
So the private equity venture capital market is very buoyant in India. I think I don't know how much is the demand for fintech. So I think in India and actually even globally, some of the sheen has been taken off fintechs because you are realizing that financial sector is a regulated sector.
Right.
And actually, at a lot of time, the startups are not so good at really kind of adhering to that. I think, therefore, the larger growth in fintechs is actually happening where they are more B2B, where they are providing solutions to banks or other established regulated players, right? Consumer fintechs actually have not had such a great time, except for a few exceptions. But private equity market, venture capital market in India is very buoyant, and I think much more so than what you see in Southeast Asia. A couple of reasons for that. One is that India and China are two countries where you have large enough middle income base for their products to take off. Second, in India, has been going back to our discussion on IPOs and the public market buoyancy, that people, private equity players have been able to see exits. Right. And I think that's been a big change and confidence booster, that people are able to see very meaningful exits in India. And that's actually leading to recycling of a lot more private capital. Maybe not as much on startups, but late stage companies, buyouts. So that market is growing. You speak to any a global private equity player, literally they are looking to grow their India business by 2 to 3x in the next 5 years, right? At least they say so. But just the experience of their exits is very, very meaningful. In fact, very interestingly, we have seen in the last couple of years private equity players being able to sell multi-billion-dollar companies from a majority 70-75% stake to completely exiting those companies. Right. So I think that's giving them confidence.
Right. And that success then begets more success.
Yeah.
Fund 1 worked out, the Fund 2, Fund 3 becomes easier. Which sectors do you see the most exuberance from the foreign perspective in investing in India?
So I think you are seeing it across the board. I think we continue to see in technology, healthcare, but increasingly even in manufacturing, many infrastructure-related sectors. Right? So whether it is data warehouses, data centers or warehouses, real estate is one sector where we don't see that much exuberance, but except for that, we are actually seeing optimism across the board. And again, a lot of these private equity players are now looking more at controlled transactions, because in the last few years, outcomes of those have been better than where they were just minority investors.
Right. I have seen private equity companies, even 5-6 years ago, going through a great deal of angst.
Yes.
I see them flexing these days. They're
Yes.
feeling pretty good about themselves.
Yeah.
That's great. So it's interesting that, both in the US and in India, this interest rate cycle has not done what it normally does, which is, take the leverage froth out of the system,
Sure.
dent valuations.
Sure.
We've seen very little of that. Your overall assessment of valuation of Indian financial markets?
Yeah, so I think there's no doubt the valuation is frothy. So today, the broader market is trading at about 21, 22 time forward earnings. But if you look at components of the market, the small and mid caps, they are trading at a very large premium to that. So those indices are trading at about 28 times earnings, just because in the last few years the growth experience there has been better. So those companies has compounded earnings at about 30% or so. So the multiples are high. I think where we are in the earnings cycle, where we are seeing recent high frequency indicators, is that there is going to be some moderation there. So you will see some pullback in the multiples. Again, my take is that it is not so much rates driven, and the US and India kind of comparison is not similar, because India actually has not had a rate cycle, right? So India, we have not had rates go up as steeply as what we saw in the US. And actually in India, through this exuberance, the M3 growth has been fairly modest, right? So if you see last year, the M3 growth was in low teens. So, so we have not actually had the central bank driving money increase. In fact,
So even base money growth has been pretty subdued.
yeah. So actually, base money growth last year was 4%. Right, so the credit multiplier was high, but the base money growth was very low. And in fact, one of the outcomes we are seeing now is that because of that, credit has actually been pulled back. So one of the reasons why you are seeing a slowdown this financial year in India is because the credit impulse has been quite negative. Right, and we are now seeing RBI change its stance towards liquidity, and we are starting to see better base money growth coming in, and that will be needed for the Indian economy to kind of get back its growth.
How is the RBI doing that? Have they just increased currency in circulation? They're doing some QE, or?
Yeah, so I think what was happening is they were actually withdrawing accommodation. So from there, they have moved to neutral stance today. Last year, actually, you saw currency in circulation getting restricted. There was withdrawal of the 2,000 rupee note, etc.
Right, yes.
So I think all that contributed to it. So now they are actually managing liquidity much more dynamically. Another angle was that the government was not spending fast enough, so the government was having nearly 5 trillion rupees of cash surplus till a few months ago, and now the government parks its cash surplus with the RBI, not with the commercial banks. So when the government has cash surplus, it's actually withdrawal of liquidity from the market, right?
And this is because of a change in liquidity management framework.
Yes. And so as now the government spending has been coming back post-election, so those balances have come. So actually in the last 6 months, we have had fairly negative fiscal as well as credit impulse in the economy. And that's kind of reflecting in the high frequency indicators in the last few months.
Great. Okay, we're going to transition to banks, but you've already brought the discussion to banks.
Sure.
You wrote those seminal papers 13 years ago, the house of debt. The banking system has come a long way since then.
Absolutely.
So a quick rundown on the journey since then to now, and
Yes.
where do you see the Indian banking system?
Yeah. So I think really those papers were actually the starting point was not looking at the bank balance sheet. The starting point was looking at the corporate balance sheet, right? And because bank balance sheets at that point were looking healthy, right? So, we spotted trouble because we looked at the corporate balance sheet. And if I look at the corporate balance sheets today, you feel quite happy about it, right? Because corporate balance sheets are very, very light on debt. So there is really no large pocket of over leverage that is visible across the board in any industry, right? And so that is very comforting that corporate leverage is very low. In fact, even as we have seen acceleration in the economy, if anything, corporates have been reluctant to add on debt. Both because of historic experience, because the last 10 years saw people going through pain both in the corporate as well as personally, right? Because never before in India the travels of the company used to become a challenge for the promoters. So, but they saw that in the last cycle. So I think they are being even more circumspect in this cycle to take on leverage. Really, there's no corporate which is, I think today has a leverage beyond 4x debt to EBITDA. Of course, the other factor is because equity markets are so buoyant. As of now, people are happy to fuel their capex ambitions through the equity market rather than rely on the debt market. So corporate balance sheets are very clean. Another challenge we saw in 2018-19 was the shadow banks, where there was not so much an issue of leverage, but it was issue of asset quality and issue of ALM mismatches. That also is not there. So most of the non-bank lenders today operate at leverage levels before 4x. Their liquidity management frameworks are as tight as of the banks as well. So that also we find very, very comforting. In fact, if you see bank balance sheets over the past 5-6 years, share of corporate loans in the bank balance sheet has come down. So about 10 years ago, it used to be almost 80% of the bank book. That number is now about 60%, so both corporate and SME put together. So we find that very, very comfortable. Last few years, the growth has been much more consumer-led. And in consumer, we are seeing some stress emerging on the unsecured consumer side, just because there has been very rapid proliferation. But again, it is not something that puts balance sheet to risk, right? So you are seeing some normalization in the credit costs, etc. But bank balance sheets are healthier than they have been ever before. I have not seen bank balance sheets as clean as this in the last 30 years.
That's great to know. So how are banks making money? Through NIMs, through fees?
So it is through NIMs, as well as very low credit costs, right? So today, the average ROE banks make is about 15-16%. And very interestingly, there has been convergence in ROE across public and private banks. So a few years ago, you had private banks making 18-20% ROEs and public sector banks making low single-digit ROEs or even in losses. I think because we are in such a favorable cycle, even public sector banks have had very low credit costs. So you are seeing literally all the banks now gravitating towards mid-teen ROEs.
But the private sector banks remain dominant. If you look at the market cap of some of the largest private sector banks, they're bigger than SBI.
Yeah, but that is to as much to do with the growth. So they are still kind of gaining market share, at least from the smaller public sector banks.
Right. Outlook for the banking system?
I think outlook is healthy. I think, of course, in terms of ROA, we have last year, I think, hit peak profitability because you have had this really good space where your NIMs were at a high and credit costs were at a cyclical low. You will drive some normalization there. But even if ROA moderates, it will still be much healthier than what it has historically been. For banking sector in aggregate, we are looking at somewhere between 1.2 to 1.5% ROA for most banks. The best run private banks will be close to 2% ROA. And as we discussed, balance sheet is very, very healthy, right? In the near term, we see some moderation in growth, both because the growth in the economy has come down, and second, the regulator has kind of clamped down on certain segments like unsecured consumer loans because it was seeing heightened activity there. Microfinance has had a pullback. So that will kind of weigh on the margins a bit. But I still think the medium-term outlook is kind of great, even though just 6-12 months earnings momentum will be decelerating. But I think profitability of banks will be fairly robust.
So Ashish, 5 to 8 years ago, bank CEOs around the world were having sleepless nights thinking that the fintech companies were so nimble and they offer such great user experience
Yes.
that if the banks don't keep up with their stodgy old school models,
Yes.
they will not be able to compete.
Yes.
Seems like they didn't have to be worried so much.
No, I think they needed to be, and I think it's good that they were worried. And I think what's happened is that you have had fintechs becoming successful when they have partnered with banks, right? And banks that have gained, and I'm sure it's true for Singapore as well, banks that have leveraged technology have been able to gain market share, and particularly disproportionate market share in the more remunerative segments, right? So I think one challenge, and as we talked about it briefly, is that fintechs in banking or in financial services cannot disrupt as meaningfully as in other sectors because it's a tightly regulated sector, right? But I think the disruption will happen by another regulated entity only, but that regulated entity which leverages technology the best, either creating its own technology or partnering with a nimble fintech.
And you're seeing it with most large Indian banks.
Yes.
Fantastic. Ashish, overall economy for the Indian going forward?
Yeah, so I think we know Indian economy is on a fairly robust footing. I think one big comfort I draw in the last 5-6 years is the macro has become very, very stable, right? Historically, whenever we talked about India from an investor's perspective, there were always a few vulnerabilities we discussed, right? So India had a high fiscal deficit, high current account deficit. There was high vulnerability to oil prices, etc.
Rainfall.
Right? So I think the macro has become very stable, and that is why I believe to a certain degree there is really comfort that you can pay a higher multiple for these earnings, right? And again, a similar thing about vulnerability to foreign flows, right? So if you recall the taper tantrum in 2013, couple of $1 billion flew out of the Indian market September 2013, right? And the market fell by 20%, currency depreciated by 10%, right? And if you see last month, about $10 billion went out of in India. So in October, foreigners have sold $10 billion. Markets have corrected, but currency has not moved, right? So I think the macro has become a lot more stable. The forex reserves are kind of all-time high. Some argue they are too high, and we have not depreciated the currency as probably it should have, and we have lost competitive. But even the current account, if you see from a level of 3-4% of
Yes.
GDP is now plus minus 0.5% of GDP. So current account is a lot more stable. Your services exports are nearly 10% of GDP, right? And they actually provide a good counterfoil to oil prices, right? So the total services exports is larger than the oil import bill, right? So I think we have had macro stability coming from all this. India has seen or will see by next year fiscal deficit really coming down by 50% from, so in pandemic we hit 9% of GDP. Next year we will be again below 4.5% of GDP, right? We are actually seeing stability across all these historical vulnerabilities, right? I think the challenge is that we are probably hitting a patch of some growth slowdown, and expectations are relatively high. Right, we spoke about the fact that because of the negative credit and fiscal impulse, growth indicators have moderated. Mass consumption pickup has not been as strong as expected. There are various reasons attributable of how post-pandemic recovery there has been slow. So those are the pockets we need to address. And if I was to summarize, I'll say that balance sheet wise we are strong. P&L wise, we are kind of losing some of the momentum.
That's a great way to summarize the current state of affairs. Very insightful conversation. Ashish Gupta, thank you so much.
My pleasure.
Thanks to our listeners as well. Kobe Time was produced by Ken Delbridge. Violet Lee and Daisy Sharma provided additional assistance. All 141 episodes of this podcast are available on Spotify and Apple Podcasts. This was for information only and does not constitute any investment advice. As for our research publication, you can find them all by Googling DBS Research Library. Have a great day.